A lot of us don't understand how the credit utilization metric works. It's gonna make you or break you when it comes down to funding, personal or business funding. I'll use this Capital One $300 card for example, because typically when we start building our credit, that's where we started. Capital One, they'll approve us like a $300 limit. So when we get these approvals of this limit right here, we don't realize that we need to be using 10% or less of our credit card. A lot of times you hear on YouTube University, oh, we need to keep the credit card at 30% or less. But 10% is gonna keep you in the green, 30% gonna keep you average. And if you over that, that's when your credit score starts to tank. When you start off with this $300, you don't have a lot of wiggle room to work with. So 10% of this $300 right here is $30. So that means you need to have $30 reporting to your credit each month in order to keep your credit profile intact. So a lot of times what we do, we start using the credit card, we start maxing it out, but we don't know why our credit score is tanking so much. That's because, like I say, you're over that 10% threshold. Well, I'm gonna tell y'all how you should actually use your credit card to being able to make sure you always in the green. For your credit card, starting off, remember, we're not even trying to invest right here. We just want to get these type of limits right here just to build with, just to make sure we making on-time payments, just to make sure we keeping the utilization low. That way the banks can trust us more and they understand we know how to utilize the credit card right. So what I would do, I would set up all my payments on this credit card out for food, Wi-Fi, phone, electric bill, and gas. And the reason why I choose this, because we're gonna spend money here anyway. We're gonna spend money regardless if we had a credit card or not. We're gonna buy this stuff anyway. That way you be able to pay the credit card back with no problem because you know your budget is gonna be within here. So any money that you was gonna pay for these things at your check anyway, what I would do is put these purchases on the credit card and then pay the credit card back in full. And the reason why you want to do this because now you know you can keep track of this. But when you want to start buying stuff that don't really matter and all this stuff, that's when the debt start running up. And now you be like, damn, what the fuck am I doing? So if you focus on these things on the credit card and pay back in full, just if you would if you had cash, this will help you keep the utilization low over here. And like I always recommend paying the credit card in full. In worst case scenario, under 10% when it's reporting. And if you do this, your credit profile is gonna go through the roof. So with that being said, y'all make sure that y'all using this strategy to take care of y'all credit utilization and you gonna be in a good spot when it come down to go and get your bag from the bank. Let's get it.